Hey everyone, welcome back. It's Finance Friday, another special edition of Money Girl. This is the show where I answer your money questions. We love getting them, so please keep them coming. Today's topic actually comes from a really good friend of mine who I'm going to keep anonymous. She said, I've had an HSA for years and recently realized that my balance was earning a little interest, but that it should have been invested all this time and earning more. Are there any other common HSA mistakes that I should know and avoid? My friend's question is an excellent reminder that to utilize tax-advantaged accounts such as a health savings account or HSA to their fullest potential, there's a lot to know. This podcast will review 7 costly HSA mistakes to avoid. Welcome back. It's episode 955 of Money Girl. I appreciate you downloading the show and spending some time with me. I'm Laura Adams, an award-winning author, on-camera spokesperson, money speaker, and founder of The Money Stack. That's my Substack newsletter. You can learn more, find out how to work with me, ask money questions, and sign up for The Money Stack when you visit lauradadams.com. All right, so I'm sure many of you have heard of a health savings account or HSA, but I'm going to give you just a quick review, in case this is something you're not familiar with. An HSA is a medical savings account that allows owners to make withdrawals for qualified healthcare expenses for themselves, spouses, and dependents. But you can only contribute to an HSA if you're enrolled in a high-deductible HSA qualified health plan. You can purchase an HSA qualified health plan through your employer or independently, like through healthcare.gov or a state insurance marketplace or a private insurance broker. And that's typically going to be the case if you work for a company that doesn't offer a health plan or perhaps you're self-employed. There are a lot of great benefits to using an HSA, but I'll just review the primary tax advantages. The first is that contributions to an HSA are tax deductible. That reduces your tax liability in the current year. Basically, the money you put in an HSA reduces your taxable income, and that lowers your taxes. And the account balance grows tax deferred, helping you skip taxes on any interest, dividends, and capital gains in the account. And finally, the HSA withdrawals that you make for eligible healthcare expenses are entirely tax-free. So those are 3 great tax benefits that make HSAs one of the most tax-efficient account options available. From doctor and dentist visits to over-the-counter medications and eyeglasses, you can pay a wide range of allowable medical, dental, vision, hearing, and alternative care costs using an HSA. However, not following the account rules or not knowing its benefits can be expensive. If you want to learn more about HSAs, I definitely want to point you to a prior episode, which is number 948, called Tips to Maximize an HSA from Tax Savings to Retirement. In addition, you can find a list of IRS-approved healthcare expenses in publication 969 called Health Savings Accounts and Other Tax-Favored Health Plans. And of course, I'll have links to those in the notes for this show. So let's talk about 7 mistakes that you should know about and avoid. Number 1 is not investing your balance. As my friend realized that she had mistakenly overlooked the ability to invest her HSA balance for higher returns, this is something that could cost you a lot over time. However, once my friend said she realized that investing was an option, she said choosing investments and funding them was very easy and straightforward. Most HSAs offer a menu of options, including mutual funds and exchange-traded funds. These are investments similar to what you'd find for a retirement account. There are even self-directed HSA options that allow you to choose and manage your own investments like businesses and real estate. However, the rules for self-directed accounts can be complex and challenging to follow. So I generally don't recommend using them unless you are, a pretty advanced investor. HSAs may require a minimum balance like 1,000 or maybe 2,000 before you can invest the rest. So consider factors like an investment fund's fees, its diversification, and how it aligns with your risk tolerance. If you plan to use HSA funds to cover short-term healthcare needs, like things that you want to spend right away, it's essential to maintain a minimum cash balance to ensure you've got liquid funds available to pay for those short-term needs. Otherwise, you could be forced to sell investments at a bad time, like when their prices go down. That would cause you to lose money. But a great feature of HSAs is that you can pay healthcare expenses out of pocket, just from your own bank account, and then reimburse yourself later from the HSA. So instead of selling HSA investments at a loss, you could wait for them to appreciate before selling enough to pay yourself back. Investing your HSA balance is a powerful strategy for building your healthcare funds and creating an extra retirement nest egg. And I'll talk more about using an HSA in retirement next. All right, the second mistake is not taking a long-term approach. If you can afford not to tap your HSA, or let's say you're relatively young and healthy and you have few healthcare expenses, you might consider paying them out of pocket and just letting your entire HSA balance grow as a long-term tax-free investment. Remember, there is no deadline to spend HSA funds. It can just roll over year to year with no consequences, no penalties. Letting your HSA stay invested for the long run turns it into a supplementary retirement account for future healthcare expenses. In addition, after age 65, you can withdraw HSA funds for any reason. However, amounts used for non-qualified expenses, things like groceries or a vacation, would be subject to income tax, similar to a traditional retirement account. But you would not have any penalty. But if you're under 65 and you use HSA funds for non-qualified expenses, again, things like, vacation or rent, you do have to pay income tax plus a hefty 20% penalty on those unauthorized withdrawals. Now, there's nothing wrong with spending an HSA balance as you go on eligible healthcare expenses. But allowing it to grow for high, unexpected healthcare costs or even for retirement could give you more financial flexibility in the future. Mistake number 3, not keeping good receipts or records. If you choose to pay qualified healthcare costs out of pocket for any reason, keep good records of those expenses because you never know when you may want to reimburse yourself for them later on. Having receipts or tagging appropriate transactions in a digital bookkeeping program or an app will make it a whole lot easier to verify your future HSA withdrawals. And some HSA platforms have online tools for uploading and storing receipts. The bottom line is that if you don't stay organized, it could be really easy to forget about paying HSA qualified expenses out of pocket, and then you would miss opportunities to reimburse yourself on a tax-free basis. Number 4, not maximizing your account. Since the tax benefits of an HSA are so good, not maxing out the account annually when you can afford it is a mistake. For 2025, you can contribute up to $4,300 when you have an individual health plan or $8,550 for a family plan. And a family plan means it's you and somebody else. It could be a spouse, it could be dependents, or both. Plus, after age 55, you can contribute an additional $1,000 with either type of health plan. Okay, mistake number 5, contributing too much. Another interesting feature of HSAs is that contributions can come from you or someone else, like a family member or employer. But unlike employer matching for a workplace retirement account like a 401k, contributions from others to your HSA are included in the annual limit. That can make it easy to lose track and over-contribute to an HSA, especially if your employer makes variable contributions on your behalf. Like it just changes from quarter to quarter or year to year. Another situation when you could over-contribute is when an HSA-eligible health plan didn't cover you for the whole year. In that case, your allowable HSA contribution limit for the year has to be prorated. Now, if you make an overpayment, it's easy to correct. I recommend contacting your HSA administrator for help. If you don't resolve an overpayment and pay tax on any growth that was created on the excess amount, you will have to pay a 6% penalty every year that the amount remains in your account. So you want to get it cleared up. But if you catch the mistake before you file taxes, including any filing extensions, you can avoid the penalty by simply withdrawing the excess amount plus any investment or interest earnings. And if you have questions about, how much investment earnings was generated on the excess, definitely get your administrator to help. They can clear that up for you. Just like with an individual retirement account or IRA, you can make HSA contributions up to your tax filing deadline for the previous year. For instance, you can fund an HSA for 2025 as late as April 15, 2026, or even later if you file an extension. All right, the sixth mistake is contributing when you're not eligible. If you lose coverage under an HSA eligible health plan for any reason, like becoming unemployed, changing insurance to a non-HSA qualified plan, or even enrolling in Medicare, you can no longer make HSA contributions. Similar to contributing to an HSA when you're no longer eligible means paying a 6% penalty on those mistaken contributions. However, you can continue spending and investing in HSA balance indefinitely, even when you don't have an HSA qualified health plan. The money is still yours, and you can use it for healthcare expenses for yourself, a spouse, and any dependents. You can continue using the same account or even roll funds over into a different HSA at a different institution. And mistake number 7, not naming a beneficiary. If you pass away without a named beneficiary on your HSA, that account will become part of your estate and will go through the probate process, which can be lengthy and costly. Just as with a retirement account, always designate a beneficiary who can assume ownership of your HSA and enjoy its tax advantage status. So thanks again to my good friend for asking the question and inspiring this show. If you're enjoying Money Girl, I would love for you to take a moment to let us know you're getting value from our weekly episodes by rating and reviewing the show in your podcast app. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank a great team that works on the show. Steve Rickyberg audio engineers the podcast. Holly Hutchins is our director of podcasts. Morgan Christensen is our advertising operations specialist. And Rebecca Sebastian is our new marketing and publicity manager. And Nathaniel Hoops is our marketing contractor.